Welcome to the deep dive. Okay, so you sent us a really interesting one this time. Adam Coffey's The Exit Strategy Playbook.
Yeah, it's packed with useful stuff.
Right. And our mission today, really, is to pull out the core insights from this playbook. We want to give you, the listener, a much clearer sense of what selling a business actually involves.
Whether it's something you're thinking about now or maybe it's further down the road.
Exactly. This deep dive should help you understand the landscape, make better decisions.
And one of the first things Coffee really hammers home is that it's not about selling fast.
No.
It's about selling smart, structuring the sale to get the value you've actually built. That's key, especially if you care about your team, your legacy. You need to understand who you're selling to.
Totally. Is it someone who's just going to integrate and slash costs, or someone who values what you've already got?
Precisely. That's strategic thinking.
Yeah, and Coffey's background really speaks to that practical approach, doesn't it? He calls himself a blue-collar CEO.
Right. Army vet, engineer.
Yeah, spent time at GE, then 20 years in private equity.
Yep. Buying, selling, financing something like 100 companies, all sorts. Medical, laundry.
Wash multifamily laundry, he mentions that one a lot.
And HVAC with CoolSys. Yeah, that hands-on in-the-trenches experience.
Yeah.
It gives his advice real weight.
No doubt. He wrote the private equity playbook before this too, right?
He did, yeah. A good companion piece, but like you said, we're zeroing in on the exit strategy today.
Okay.
And what's really interesting is his point that prepping your business for sale, all that work.
Getting your ducks in a row.
Exactly. It actually just makes your business fundamentally stronger, more resilient right now, even if you don't sell for years.
That's a great takeaway right there.
Yeah.
Okay, so let's jump in. Different types of buyers. The book really starts by drawing a line between strategic and financial buyers. Can you break that down for us?
Sure. So strategic buyers, according to Coffey, are basically other companies. They buy for strategic reasons. Maybe they want to get into a new market, or maybe get bigger in a market they're already in. He calls that building density.
Okay.
Or maybe they want your specific expertise, your tech, your IP, something like that.
He uses some big examples, right? Morgan Stanley buying E-Trade.
Facebook and WhatsApp.
Amazon and Whole Foods.
Exactly. The main goal there was strategic. Grab customers, market share, geography, know-how. And Coffey actually breaks strategic buyers down into two types, which I found really useful.
Oh, yeah. What are they?
He calls them turn the lights off buyers and join the team buyers.
Okay, turn the lights off. Sounds ominous.
Yeah, a bit. But basically, this type is really focused on your customers and maybe expanding their density. They usually have their own big corporate setup management, HR, finance.
So they don't necessarily need yours.
Right. So especially if they buy a similar company nearby, they often consolidate, cut overhead, eliminate redundancies.
Which often means layoffs.
Unfortunately, yeah, often in the back office. It's about efficiency for them.
He uses the Wawash multifamily laundry example for this, doesn't he?
He does. They'd buy similar businesses, use their own field ops, but maybe cut the duplicate overhead after a, short transition with the old owner.
So the real value was the customer contracts and the market density.
Pretty much. Those long-term contracts, access to buildings, that was the prize. The relationship with the seller was often shorter term.
Okay. So how is that different from a join-the-team strategic buyer?
Well, this type, and he uses his CoolSys experience here, they really value the existing team, the expertise, the relationships.
They want the people, not just the assets.
Exactly. They want the owner, the key employees to stick around. Their goal is integration, keeping that talent for the long haul.
Why the difference?
It often depends on the buyer's own platform. Maybe it's still growing, or the business they're buying has really specialized skills they need.
So at CoolSys, maybe the contracts weren't as long-term or the relationships were more critical.
That seems to be the idea. Keeping those owners and their customer knowledge was crucial for growth. It really boils down to what the buyer values most: market share or capabilities in leadership.
And for a seller, especially one who cares about their employees, knowing the difference is huge.
Absolutely critical. Coffey says you should ask some direct questions.
Like what?
Things like, so what are your plans for my company after the deal closes? Or is this a buy and build? Are you planning to, turn the lights off? Or are we joining the team?
Pretty direct.
Yeah, but you need that clarity. It helps you picture the future for yourself and your people.
Makes sense. Okay, let's shift gears. Financial buyers. We're mainly talking private equity, right?
Primarily, yes.
Yeah.
Coffey uses this analogy. He calls private equity firms sort of like a private mutual fund.
Okay, how so?
Well, they pull huge amounts of cash, usually from big investors, pension funds, university endowments, wealthy individuals. Minimum investments are often in the millions.
Right.
And then they use that pool of money to buy or invest in private companies.
So it's pooled like a mutual fund, but different.
Key difference is liquidity. Mutual funds, you can usually sell your shares pretty easily.
Yeah.
Private equity, it's illiquid. Investors lock up their money for the life of the fund, typically about 10 years. No easy way out early.
10 years. What happens during that time?
Well, Coffey lays it out. The first few years, they're usually busy buying companies making those initial platform investments.
Okay, the main companies.
Right. Then the middle years, that's all about growth, improving operations, and often doing buy and build.
Adding smaller companies onto the platform.
Exactly. Then in the later years, the focus shifts to selling those bigger, hopefully more valuable combined companies to make money for their investors.
That buy and build seems like a core PE strategy.
Oh, absolutely. They buy a solid platform company in an industry, then they hunt for smaller add-on acquisitions that fit strategically.
Why do that?
Scale, market presence.
Yeah.
Efficiencies. It makes the whole thing much bigger and more attractive when it's time for them to sell later on.
Okay, but what if I'm listening and thinking, my company's way too small for private equity?
Coffey actually gives a way to estimate what size PE firm might be a fit. It involves your EBITDA.
Okay, EBITDA, earnings before interest, taxes, depreciation, and amortization. We'll definitely dig into that more later.
Right. But say your company has $5 million in EBITDA. And maybe similar companies in your industry sell for, I don't know, 10 times EBITDA.
So a $50 million enterprise value, roughly.
Exactly. Then, if PE deals in your sector typically use, say, 5 times leverage, that's debt financing,
Okay.
the equity part the PE firm puts in might be around $10 million.
Right.
And if a typical PE fund wants to make maybe 10 platform deals like that.
Then you're looking for a fund that's maybe $100 million or bigger?
Something like that, yeah. It's just a rough guide, but it helps you ballpark the scale.
That's really helpful. Now, what about rollover investment? That comes up a lot with PE deals.
Yeah, rollover. That's when you, the seller, don't take all your money off the table in cash.
You reinvest some of it.
Exactly. You reinvest a chunk of the sale price back into the company alongside the PE firm. Coffey calls it getting a second bite of the apple.
Why would I do that?
Well, the idea is the PE firm uses its money and expertise to grow the business even bigger, maybe through more add-ons. Your reinvested piece grows too.
So you could potentially get another payout later when the PE firm sells the whole thing.
Potentially much bigger payout, yeah. It aligns your interests with the buyer's growth plan.
He had that CoolSys example, right? Like a $16 million initial payout,
Yeah.
$4 million rollover.
And that $4 million turned into another $16 million later on.
Wow. So the seller got $28 million total instead of just $16 million.
Precisely. So yeah, some people just want to cash out 100%, take the chips off the table. Understandable.
Sure.
But Coffey makes a really strong case that rollover lets you leverage the PE firm's resources for potentially a much bigger final return on your life's work.
Okay, so strategic and financial buyers are the big ones.
Yeah.
But the book mentions other options too, right? Alternative buyers.
Yeah, several alternatives. Depends on your goals, your situation. A common one for smaller businesses is the owner-operator.
Like dentists, plumbers.
Exactly. Service businesses often, maybe a younger person or team buys it, the seller stays on for a transition. Often involve seller financing, too.
Coffey mentioned he and his brother did that, buying an insurance agency. The seller helped finance it.
Right. And there's a related thing called search funds.
Search funds.
Yeah, basically small groups, often recent MBAs, who raise a bit of money specifically to find one company to buy and then run themselves. Kind of a hybrid.
Interesting. What else?
Management-led buyouts or MLBOs.
So the existing managers buy the company.
Yeah. Often happens when a founder wants to retire. The key, Coffey says, is the management team stays in control. You see this a lot in family businesses going to the next generation.
Okay. And then ESOPs, employee stock option plans. What's the verdict there?
2 main scenarios for ESOPs. One is, an owner genuinely wants to reward employees, give them ownership, can have tax advantages too.
And the other?
The other is maybe a seller just can't find another buyer. But Coffey, he's not a huge fan of ESOPs as an exit strategy.
Why not?
His main concern is complexity down the road. If you ever want to sell the whole company again later, getting agreement from potentially hundreds of employee owners, it can be a nightmare.
Yeah, I could see that. Okay, what about the really big exits? Going public.
IPOs, initial public offerings. Coffey touches on them, but stresses they're really only for very large companies. We're talking like $100 million, maybe $500 million plus in revenue, ideally closer to $1 billion.
So, not for most businesses.
Generally not. He does mention the dual path idea, exploring an IPO while also looking at selling to strategic or financial buyers. Keep options open.
And SPACs, special purpose acquisition companies, they were hot for a while.
They were. Basically, a shell company goes public first, raises cash, then looks for a private company to buy.
So where do they fit?
Coffey kind of sees them as a hybrid, maybe between strategic and financial buyers. They bring public money, often have a target industry, but he still thinks the odds of a typical owner selling to a SPAC are pretty low.
It's interesting how these alternatives often fit specific seller needs, isn't it? Like owner-operator for retirement in a small service firm, or an MLBO for family succession.
Absolutely. And Coffey keeps coming back to this. Having the right advisors is key to figuring out which path makes sense for you.
Right. Okay. Advisors.
Yeah.
We'll get to that. But first, let's talk money, maximizing value. The book really digs into financial reporting and how buyers scrutinize, 3 years of data?
At least 3 years, yeah. And they look hard. Coffey points out something super common in founder-run businesses.
Mixing personal and business expenses.
Bingo. Running the car through the company, maybe some travel. It's common. But he says you have to identify and track that stuff cleanly. It's crucial for normalizing your EBITDA when you sell.
Okay, let's define EBITDA again clearly. Why is that the magic number?
Right. Earnings before interest, taxes, depreciation, and amortization. Coffey explains it's the main metric buyers use for valuation. It strips out financing decisions, interest, taxes, which vary, and non-cash accounting stuff like depreciation.
So it levels the playing field.
Exactly. It gives a clearer view of the core operating profitability, the underlying health of the business, compared to just looking at, say, net income or cash flow. Helps compare apples to apples.
And the book talks about different EBITDA adjustments. What are those?
Yeah, ways to fine-tune that number. First, extraordinary expenses.
One-offs.
Right. Things that aren't part of normal operations, like maybe you paid big severance costs for a one-time restructuring. Sellers try to add back those costs to show the true ongoing profit.
Okay, what about normalizing adjustments?
Those adjust for things that will be ongoing costs for the new owner, but maybe aren't reflected currently. His classic example is rent.
If the owner owns the building and doesn't charge the company market rent.
Exactly. A buyer will have that rent expense, so you adjust EBITDA down to reflect a fair market rent. Make it realistic.
Got it. And out-of-period adjustments.
Those are just corrections to make sure income and expenses land in the right time period. Maybe a big bonus paid in January was really earned all last year. You might adjust to spread that cost. Timing stuff.
Okay, then pro forma, adjusted EBITDA. That sounds forward-looking.
It is. It takes all those other adjustments and adds a layer of projections.
Like what?
Could be based on changes the seller already made or plans to make, or changes the buyer plans to make post-close. It also tries to factor in the full year impact of, say, a big new contract you just signed or maybe one you just lost.
But Coffey warns about getting too optimistic here, right? Mixing Kool-Aid. Yes,
Yeah.
he does. And it's a serious warning.
Huh.
You have to be realistic, have solid proof for those projections. Buyers will tear them apart in due diligence.
Right.
Overpromising kills trust fast and can sink a deal or lower the price. Accuracy is everything. He also mentions TTM EBITDA briefly, just trailing 12 months, looking at the last year. So the big picture here is understand EBITDA, manage it carefully, track those adjustments meticulously. It directly impacts your sale price.
Absolutely. Coffey basically says it's a game you need to understand and play well. Clean books, credible adjustments that builds trust and gets you a better valuation.
And he mentions the value of getting a sell-side quality of earnings report done before you go to market.
Huge benefit, he says. It's like getting your own financial due diligence done up front by an independent firm. Shows buyers you're serious, your numbers are solid, can really boost confidence and maybe even attract higher bids.
He also quickly mentions cash versus accrual accounting and GAAP.
Yeah, basically cash accounting, money in, money out, is simple, common for small shops. But accrual accounting, revenue when earned, expenses when incurred, gives a much truer picture of growth and health.
And GAAP, generally accepted accounting principles.
Sticking to GAAP makes your financials more transparent, easier for sophisticated buyers to understand and trust. It just reduces friction.
Okay, so getting the finances tight is critical. But preparing for sale goes beyond the finances, right? What else does Coffey highlight?
Real estate is a big one if you own your property. Sell it with the business or keep it and lease it back to the new owner.
Become a landlord.
Could be an option. He mentioned Wash Ash owned a lot of real estate, so the original owners could potentially do that. It's a big decision.
And your own personal goals are huge, too. Stay on, retire completely.
Absolutely critical. And interestingly, Coffey says most financial buyers, the PE firms, actually want the entrepreneur to stick around for a while.
Really? Why?
They're often buying your expertise, your relationships, your leadership, just as much as the company itself. But if you do want to retire fully, you need to be upfront about it and have a solid transition plan.
Which leads right into succession planning and team development.
Exactly. Buyers need confidence the business isn't just you. Having a strong number two, a capable management team. Coffey calls that a golden ticket.
Because the business can run without the founder being there 24/7.
Precisely. It de-risks the deal for the buyer. And you also need a compelling growth story.
What does that involve?
How will the business grow next? Organically, through price, volume, margin expansion, better processes, tech. Maybe you've identified some smaller companies you could buy first, a mini buy and build. Buyers want to see clear paths to accelerated growth.
And finally, he talked about looking back, understanding how the business handled tough times.
Yeah, the peak to trough analysis. How did you do during the last recession, during the pandemic?
Resilience.
Huge factor. Businesses that prove they could weather storms or pivot effectively are seen as less risky, more valuable. He encouraged thinking about how you could make your business even more resilient. That impresses buyers.
Okay, so you've done all this prep work. Now you need help actually selling the thing. Coffey really emphasizes building an advisory dream team. Who's on it?
Non-negotiable number one, a top-notch tax advisor.
For personal and corporate taxes.
Both. The tax implications of a big sale are massive. State residency alone can make millions of dollars difference. He uses the California versus Nevada example. Plus, structuring the deal consequences. You need an expert here.
Okay, tax advisor. Who's next?
Your accountant, but ideally one with specific transactional experience.
Not just the person who does your regular book.
Right. You need someone who understands how to normalize financials for a sale, maybe help with that sell-side quality of earnings report we talked about, get everything ready for buyer due diligence. Coffey suggests checking resources like accountingtoday.com to find firms with that M&A focus.
Makes sense. And then a lawyer.
Absolutely. But again, not just any lawyer. You need an M&A specialist.
Why the specialist?
Sale agreements are incredibly complex. Lots of jargon, potential traps. An M&A lawyer lives and breathes this stuff. They know the terms, they protect your interests, they understand the difference between asset deals and stock deals and what that means for future liabilities. Coffey mentions ILRG and Vault.com for finding good M&A firms. Don't use your general counsel for this.
Okay, tax, accounting, legal. Who else? The big one.
The investment banker or transaction advisor. Coffey calls them the real estate agent for your business.
So they manage the wholesale.
Pretty much, yeah. They prep the marketing stuff, the teaser, the detailed CIM, confidential information memorandum.
Sure.
They know the universe of buyers who's likely interested, who can pay. They reach out, manage the bids, run the negotiations, guide you all the way to closing.
Their network and deal experience are key.
Invaluable. Even sophisticated PE firms use bankers when they sell companies. Their expertise in structuring the deal and creating competitive tension can add huge value.
How do they get paid?
Usually a percentage of the final deal price. Often on a sliding scale, the bigger the deal, the smaller the percentage. Might be a small retainer up front, but the bulk is a success fee when the deal closes. Sometimes extra fees if they get a price above a certain target. Vault.com, mergersandinquisitions.com are places to research firms.
Okay, dream team assembled. What does the actual sales process look like when a banker's running it?
Coffey lays out a typical timeline, maybe 4 to 6 months, assuming you've done your prep work.
Timing matters too, right? When to launch.
Yeah. He suggests early in the year is often good. Avoid big holidays, maybe that August slowdown when people are on vacation.
He uses a funnel analogy for the stages.
Right. Starts wide, gets narrower, first step. The teaser.
The anonymous one-pager.
Exactly. High-level snapshot, no names, goes out broad to gauge interest. He had funny code names like Project Drano for a plumbing company, Project Iceman for CoolSys. Keep it confidential.
Okay, someone bites on the teaser?
Then they sign an NDA non-disclosure agreement, promise to keep things secret. Then they get the CIM or CIP, the big detailed book. 50, 100 pages sometimes. All about the company, industry, management, financials, growth story.
The serious info dump.
Right. After they digest that, next come initial chats.
Fireside chats.
Yeah, high-level calls. Buyer asks questions, gets a feel for management. If they're still keen, they submit an IOI, indication of interest.
A first offer.
Sort of, non-binding, usually a price range. Shows they're serious.
What's next in the funnel?
Management meetings. This is key. Buyers meet your team, maybe tour facilities, really kick the tires on operations, culture, leadership.
So preparation for those is crucial.
Hugely. After those meetings, buyers usually submit refresh bids or an LOI, letter of intent. This is usually a harder number, more detailed terms.
Then you pick one.
Generally, yeah. You grant exclusivity to one bidder for a set period.
Why?
So they can do their deep diligence without worrying you're still talking to others. Diligence is expensive for the buyer. Lawyers, accountants combing through everything, financials, legal, operations, customers.
The real deep dive.
Totally. If diligence goes well, no skeletons pop out, then you finalize the purchase agreement and move to closing. Deal done.
It's quite a process. He also mentioned being somewhat transparent with employees during this.
Yeah, his view is keeping people totally in the dark breeds rumors and anxiety. Better to acknowledge something is being explored even without details to maintain morale. Tricky balance, though.
Definitely. Now, during all this, how should the entrepreneur interact with buyers? Those meetings sound high stakes.
They are. Coffey says your role in those fireside chats, management meetings, dinners, it's critical. You got to be confident, engaging, know your stuff, be passionate.
Sell the vision.
Exactly. Your banker should coach you heavily for this. Practice, practice, practice. Coffey's rule. 1 hour of practice per slide.
Oh.
And maybe, obviously, don't blow it with unprofessional behavior. He warns about, having one too many at a dinner with a potential buyer. Keep it professional.
Good advice. Okay, we talked about rollover briefly. The book gives it a whole chapter, along with other residual income ideas.
Yeah.
Why is he so big on rollover?
Because he genuinely believes it's often the path to the biggest total financial win for the seller.
Even though you don't get all the cash up front.
Right. That second bite of the apple idea. You benefit from the PE firm's resources and growth plan. Your rolled equity potentially grows significantly. He even offers that law of rollover guideline.
Take 66%, roll 34%.
Something like that, aiming for maybe a 3x return on the rolled amount. He argues it often beats taking 100% cash up front if the PE firm executes well.
We saw that with the CoolSys example. Big potential upside.
Huge. And rollover isn't the only way to get ongoing income.
Wow.
You might negotiate a consulting agreement for a year or two. Keep sharing your expertise. Get paid for it. Oh. Or if you kept the real estate, leasing it back provides rental income.
So you give up control, but there are ways to stay involved financially.
Exactly. And often the buyer wants you involved in some way, at least initially.
Okay, fast forward. You run a good process, you get multiple offers. Now you have to choose a winner. It's not just the highest price tag, is it?
Absolutely not. Coffey warns against that. You have to look at the whole picture.
Like what?
Buyer's reputation. Are they known for closing deals smoothly? Are they financially solid? Is their funding certain? What are the actual terms? Cash versus stock? Any weird contingencies or earnouts?
And their plans for the business, especially if you care about your team or plan to roll over equity.
Crucial. What's their vision? Does it align with yours? He tells that story about the Love U.S. deal.
A higher bidder with shaky financing.
Yeah, almost killed the whole thing. His point. Time is never your friend in a deal. Certainty matters. A slightly lower offer from a solid, reputable buyer you trust might be much better than the highest bid from someone iffy, a bird in the hand.
Makes total sense. Wow, this has been a really thorough look at Coffey's playbook. So much ground covered. Any final key takeaways for our listeners?
I think the biggest message is selling a business successfully. It's a marathon, not a sprint. It takes serious planning way ahead of time.
Yep.
You need to understand the buyers. Get your financials truly dialed in, especially that EBITDA number. Build that expert advisory team. Know the process. And think strategically about your goals, including rollover potential.
It really feels like the insights here give you a solid framework, a foundation for making smart choices whenever that exit might be on the horizon.
Yeah.
Maximize that value you've worked so hard to build.
Definitely. And maybe a final thought to leave people with.
Yeah.
Regardless of where you are now, just starting, scaling up, thinking maybe retirement's a decade away, start thinking today about your long-term vision. What do you ultimately want for the business? What do you want personally from an exit?
And which type of buyer might actually fit that vision?
Exactly. That foresight, that early strategic thinking, Coffey makes it clear that's the absolute first, most critical step towards a truly successful exit down the road.